This question tests your understanding of management by exception, MBE, an important management control principle used in budgeting, variance analysis, and performance reporting. Under management by exception, managers focus their attention on significant deviations from planned performance, rather than reviewing every transaction or routine report. This approach improves efficiency by directing management effort toward areas that require corrective action. The phrase, except, is critical because the question asks for the statement that is not a benefit of management by exception reporting. Typical benefits include reducing information overload, allowing managers to concentrate on important issues, and minimizing unfocused management actions by highlighting only material variances. However, management by exception does not reduce the need for advanced planning. In fact, it depends heavily on effective planning because managers must first establish budgets, standards, or performance targets against which actual results can be compared. Therefore, understanding the relationship between planning and variance reporting is essential for selecting the correct answer. A. Reports production costs. Incorrect. Reporting production costs is a function of accounting systems, not a recognized benefit involving reduction under management by exception. B. Information overload. Incorrect. Management by exception reduces unnecessary reports by highlighting only significant variances. C. Reliance on advance planning. Correct. Management by exception does not reduce reliance on advance planning. Instead, it requires well-developed budgets and standards to identify exceptions. D. Unfocused management actions. Incorrect. By concentrating attention on significant deviations, management by exception helps reduce unfocused managerial effort and improves decision-making. Correct answer. C. Reliance on advance planning. Management by exception reduces information overload and unnecessary managerial attention, but it depends on strong advance planning and established performance standards, making reliance on planning an essential requirement rather than something that is reduced. This question tests your understanding of the variable overhead efficiency variance in a standard costing system. Variable overhead costs, such as indirect materials, indirect labor, utilities, and machine-related costs, are often applied based on direct labor hours. The variable overhead efficiency variance measures whether the actual activity base, direct labor hours, used is greater or less than the standard hours allowed for actual production. A favorable efficiency variance occurs when actual labor hours are fewer than the standard hours allowed, indicating greater production efficiency. This can result from better trained workers, improved production methods, or superior quality materials that reduce processing time. Students should distinguish efficiency variances, which relate to hours worked, from spending variances, which relate to the prices of overhead items such as electricity or supplies. Higher skilled labor was used. Correct. More skilled employees often complete production in fewer direct labor hours, reducing the activity base used to apply variable overhead. This leads to a favorable variable overhead efficiency variance. B. Electricity rates were lower than expected. Incorrect. Lower electricity rates affect the variable overhead spending variance, not the efficiency variance. C. Less supplies were used than anticipated. Incorrect. Using fewer indirect supplies influences the spending variance, since it changes the cost of overhead rather than the labor hours used. D. Less units of finished goods were produced. Incorrect. Producing fewer units does not necessarily improve efficiency. The efficiency variance compares actual hours with standard hours for the actual output achieved, not with planned production. Correct answer. A. Higher skilled labor was used. Higher skilled workers can complete production using fewer labor hours than the standard allows, reducing the variable overhead applied through the labor hour allocation base and creating a $25,000 favorable variable overhead efficiency variance. This question examines material price variance analysis and the appropriate managerial response when an unfavorable variance is caused by an external factor beyond management's control. The material price variance, MPV, measures the difference between the actual price paid for materials and the standard price, multiplied by the quantity purchased. An unfavorable price variance means the company paid more than expected for raw materials. However, variance analysis should not only identify the variance, but also determine its cause and controllability. In this question, the only supplier unexpectedly increased prices, meaning the purchasing manager had little or no ability to prevent the increase. Under the principle of management by responsibility, managers should be evaluated only on factors they can control. If a price increase is expected to continue, the standard cost should be revised so that future budgets and performance evaluations remain realistic. The key concept is distinguishing controllable internal performance from uncontrollable external events. A. Negatively evaluate the performance of the purchasing manager. Incorrect. The purchasing manager should not be penalized for an unavoidable supplier price increase beyond his or her control. B. Negatively evaluate the performance of the production manager. Incorrect. The production manager is responsible for material usage, not purchase prices. C. Change the raw material price standard. Correct. If the supplier's price increase reflects a new market condition that is expected to continue, the company should update the standard price to provide realistic budgeting and performance evaluation. D. Ask the production manager to lower the material usage standard to compensate for higher material costs. Incorrect. Material usage standards should reflect engineering and production efficiency, not be adjusted simply to offset higher purchase prices. Correct answer. C. Change the raw material price standard. When an unfavorable material price variance is caused by an uncontrollable increase in supplier prices, management should revise the standard cost rather than unfairly evaluating managers or altering unrelated production standards.